Hey, good morning. Can you hear me? Okay, can you hear me?
Yes, can hear.
Okay, thank you. Okay, so today we covers step acquisitions. Okay, so this topic will cover in your midterm for your lecture 1 until today, lecture 5. Okay, so lecture 1 to lecture 5 will be in your midterm, in your progress test, and in your mock exam and your midterm. So you better pay attention on these topics. Okay, let's start now. So changes in group structure. So group structure change. So this time we change it. We start with this lecture with step acquisition, or sometimes we call piecemeal, piece by piece, or step by step, or stages by stages acquisition. So what we mean by all this? So easier by drawing you a simple charts. Use some big notes here. I said P per heart, make it simple. So P for parents. Okay, so they buy over a subsidiary called S per heart. So initially, they say the first time they buy, they say year 1, they bought 10%. So this is nothing. This is a normal investment. Okay, so trade investment, we call it. So just like you buy a lot, 1 lot, 2 lot of share in Maybank, Gending, Samdabi, and so on. So this is a normal investment. You're waiting for the dividend or the share price go up, you just sell it. But we come to year 2, okay, they bought another, let's say, 50%. Okay, we'll change it to 40. Change it to, let's say, some other figure, which is, okay, you buy under 60%. So now you have 70%. This is piecemeal. First piece is 10%, second piece is 60%. Or step, first step 10%, second step under 60%, or 70. Or stages. All these 3 are the same meaning. So our standard style, you call this step acquisition, step by step. Okay, so first step 10%, second step 60, now you have 70. Now we become a subsidiary on this date. Okay, in year 2. So the accounting treatment are different when you reach a subsidiary. Okay. So I explained in my note here. So this could be quite complicated. Okay. So because it's a different scenario, different step you can come in. Okay. So then in your first step, you just an investment in equity, the trade investment. Okay, IEI under MFRF 5. Okay, for sales. But after that, the company, as a result, they buy several successive share purchase, like given here, 10%, another 60%. Or what happened? They buy another. Okay, so they buy another 15%, year 3. So now you have 85%. So these different stages, accounting treatment are different year 1, year 2, year 3 are different. Okay, so today what we are learning at different step, at different stage. Okay, basically in my note here, we've given you 3 types you have to know. For example, versus. So 3 possible way. Okay, first one is previously held interest, existing 10%, no significant influence. It means it is not a associated company. Increase to a controlling interest of 50% or more. Like what happened in my slide. So first is 10%. So you buy, so this is just a trade investment, no significant influence. So cannot treat it as associate. Then you buy another 60%, now it becomes 70% subsidy. So now at this stage, what you need to do is compute goodwill. When you compute goodwill the normal way, consideration minus plus NCI minus 10%. Okay. So this is the first type, 10% at 60 equals 70. So the other types like B here, previously held interest is 35%. So 35 is between 20 to 50. So it treated an associate under MFRA 128. So you increase the control interest to 50% or more. So now we have another scenario here, type 2. We give a name here called type 2. So now we have the P here. IS. So initially you have 35%. So 35% is an associate. So remember, associate we use equity accounting. Equity accounting means we share the post-acquisition profit. So from the day we become associate, you share 35% of profit until each financial year. Okay, year end, 35% of it profit after tax. So with that, we debit investment in associate and credit profit and loss share of associate profit. That's why you must remember and learn your CR level. So which I've been teaching for the last 2 lectures. Okay, if you do understand this, then now it become complicated. Now the basics. What happens is now you buy another 30%. Stage 2. Let's say the year 1, year 2, you buy 60% here, 30%, now you have 65%. Now you do console. So first you do console what? You compute your goodwill, GW, when you reach 65%, which is more than 50. Okay? Then you have NCI. So NCI here, 35%. So they have computed your group retained earning. And on top of this, the previously 35% here, you have to stop when you reach 65. Okay? Then you have to remeasure your previously, remeasurement of the 35% at fair value FV when you reach in year 2 when you reach the 65%. So the remeasurement will give you more example. Okay? So the previously held share, you must remeasure it at the value when you gain control. This is a share price when you bought the 30% share price at $3. Your previous 35% one you will value at $3 per share. So this is type 2. So the third one, type C or type 3, a controlling interest in subsidiary increase from 60 to 80. So this is what will happen. Like I could just give a name called type 3. So P S. So initially they will have 55%. So already a subsidiary, you compute goodwill, NCI and so on, but you add in another 20%. Now you have 75%. So this we call it retain control. So still within your control, accounting treatment difference. So it's a movement between NCI and the parent. Now the NCI initially, you have 45%. Now become 25%. Because the 20% NCI was bought by the parent. So parent increased from 55 plus 20 becomes 75%. Okay, let's give you a rough idea. We have 3 types. So then we will learn in detail each type, what are the accounting treatment. Okay, now we go to the more in detail. So we bear in mind.
Sir, may I ask, there's nothing special about the type 3, right?
Yes, it's special. You don't need to compute goodwill. Once already, you do compute goodwill at 75%.
Oh, no need to compute goodwill.
Yeah, goodwill only compute at 55. When you reach 75, no need to compute.
Oh, okay.
Okay, each types are different, the treatment, but I won't tell you now first. I just want you to know the 3 types. Okay? Good question. So each 3 types of accounting treatment are different. Okay, like just like I told this student asking, type 3 is different. You need compute at 55, not 75. So this is the movement between the shareholder, mean the parent shareholder and the NCI shareholder. So we come to that, don't worry. Okay, we give you more detail one. So we give you two charts. Is when you cross the 50% mark here, so you become subsidiary. Okay, between 20 to 50 is an associate, significant influence. If you jointly control it, one or more parties, so it become a joint control. Remember all the basics, huh? Okay, if anything less than 20, just a normal investment, trade investment. Okay, this is the basics you must know. Okay, so we have 3 level is trade investment, you less than 20, between 20 to 50 is a significant influence or joint venture. More than 50, you have control. So become your subsidiary. Okay. So all these 3 stages, the accounting treatment are different. So first one, investment associate become a subsidiary. So now we do this type is, so normal investment or associate. So the one between the type 1 now we have, just how I explained, 10%, you bought 60, you get 70, or you have 35%, you bought 30, becomes 65. How we should do the treatment. Okay. So remember when we teach you last 2 weeks, the lecture, so you have task 1, task 2, task 3, or this, okay? So same thing, we have to do our task 1 first, goodwill computation. The goodwill the same with the previous one, with one addition line here called fair value of previously held share. When an investment or associate becomes subsidiary, investment to subsidiary. See the heading, step acquisition, piecemeal acquisition, investment subsidiary. So you have to add in one. Remember, let's say we have 10% here. These are 10% of previously held share where you bought the 60. So before it becomes subsidiary, you previously held the share, what the value. But this value must be fair value. Fair value means the value at the time you gain control. So like all the other components when you compute the goodwill, your consideration at the date you become acquisition value, the date you become control, and same thing, fair value at date of control, and the net asset the same. In fact, the whole goodwill computation must be fair value at the date of acquisition, mean the date they become you have control. Okay, so the format, remember this goodwill computation like given here. So the highlighter in red here is the same with the goodwill computation. I will arrange it in the goodwill computation format, much easier for you to understand and remember. Okay, let's we do the one example how we do it. Question 1, piecemeal acquisition here. Okay, so in this case, a good whose year end is 30th June. So a company called Good. Okay, year end 30th June has a subsidiary called View. Yeah, View is a subsidiary. So now what you can do is, so acquire in stages. So you know where this is step acquisition. So what happened at 1st July? They have 20%, they acquire. So the time the retained profit 270 and they pay 120. This is previously they bought it 120. In 1st July, X7. So when it comes to 1st July, X8. So in 1st July 2000, X8. So you bought under 60%. Now you have total 80% here. So the retained profit 450. Then they purchase for 480. So in this case, now we achieve control when you bought another 60. So in terms of diagram here, so mutual sell 20% plus 60, you got 80%. So in this case, so we have how we compute the goodwill. So first, same thing, it costs a consideration, you're buying the 60%. Let me type here 60.6. Your previously is 0.2. The left behind is 0.2, so I put in percentage term, it's easier for you to understand. See. So that you pay the 60% of the time, you pay 480. So you just type here 480. So NCI, they haven't told us yet. The previously held share mean the 20% one is the value on 1st July X8. Okay, you must go to the X8. Okay, then we see how much they're paying for the X8, the 60% of it. Okay, the share of view, let's come back to the questions. The share of view have remained unchanged, share capital. So they don't change. So easier, then percentage still maintain 20%, 60. Incorporate 300 million. So they have 300 million share in view, it means subsidiary. So 20% of 300 million, it means 60 million shares. Okay, previously held. The fair value of net asset of view will be the same as the carrying amount at the date of acquisition. So everything the same. The net asset or fair value easier. So no fair value adjustment this time. Okay. Goodwill did not have any significant overview at any time before controlling. So they say the 20% they have one to have significant influence mean View is not an associated company. It's not an associate. So they said did not have significant influence. So the good process is to measure and set a proportional share of fair value at the subsidiary net asset. So they're using fair value method. Okay, they ask you to compute goodwill at acquisition of view. So now we have this show the share capital. We know that is 300. So I put in the one we know. So retained profit given here 450. 1st July X8. So 450. So you do have fair value adjustment because they equal to the net asset. Fair value the same. So they say the 20% here is how much is based on fair value. Proportion share of fair value. So we know 60% they pay 480. So 20% how much? So 480 is 60%. So you divide 60, you multiply with 20. 160. Agree? So you bought the 60% of it, you pay 480. So it's 20%, how much proportion? So will be 160. Okay? Use proportional method. Okay? You can convert to the number of price per share. So 160 for the share here. Okay, for the previously held share 160. Okay, I'll just change it. So you bought 60%, you bought 480. So the previously held share at fair value will be fair value at the time they bought the 60%. 20% of it will be 480 divided by 60 times 20%. So the NCI is based on proportional share of net asset here. So the net asset is 750. So 35% means 750. So you go 750 times 0.2. 150. So you get a good view of 40. So up to here, any questions? Can follow. So basically, yes.
Is it the the parent hold the 80% share of the subsidiary.
Yeah.
Yeah, then
So 80.
so it's
80 plus 20.
so even
So initially you have 20%. You buy 60, you got 80.
so even it has assist the 75%, you still need to calculate the goodwill.
75%, where you come up with 75%.
No, this one just now you say the type 3, right? If the
No,
company,
we haven't come to type 3 yet. Now we
yeah.
go back to this. This type is from investment to subsidiary. Type 1.
Okay.
So type 1, this is a treatment.
Yes.
Then go to type 3 first.
If the type 3 does not need to calculate the goodwill, is because they already calculate the goodwill, so they do not need to calculate the goodwill,
Yeah,
right?
but I haven't reached to type 3 yet. So
I
type
just want
3
to,
one, 55%, the time you compute the normal goodwill, your subsidiary already.
okay.
Then when you buy under 20%, you don't need to compute goodwill. Don't go to type 3 first because it's step by step. You finish type 1 first, type 2, then type 3. So I'm asking you, this is a type 1 investment to subsidiary. So in this case, you need to add in the fair value of previously held shares.
Okay, thank you.
Okay, any other question? So this is part A required. Part B, they're asking you, profit de-recognize any previously held investment. So they said previously held, previously they held 20%. Okay, they bought at 120. So now the value at 160. So you are untung. Okay, previously you held the 20% you bought, you see purchase consider 120 million. Now the value to 160. You bought more, the value go up. Okay, so this is your investment gain 40. Okay, the previously you have one is 120, you get from here. 1st July X8, 120 here. See my arrow here. So now if fair value 160, here on the fair value of the 60%, 480, 20%, 160. So 160 compare 120 got 40. So this one you go to your P&L. Okay, it's just like previous, 2 years ago, you bought Maybank share, that's $3. Okay, you buy more share now, the share price now is $5. So the $2 go up. It's a previously held share, you gain $2 per share. So as simple as that. So they will tell people, oh, my share value are $5. You don't say now how much, not what you previously held. Okay. So this is a quite type 1, mean investment become subsidiaries. So now we go and one more is slightly more complicated, 1.4 here. So first we read out the requirement, what they want from you. Required, prepare a consolidated profit and loss and OCI under comprehensive income and statement of financial position for Punchat Group at 31st December X2. So here, the acquired one, the way you do is 25% interest in Sehat allow Punchat significant influence. So you know that the Sehat is a subsidiary. Interest in Sehat. So Punchat significant influence means Punchat is the parents. Okay. So when you have a subsidiary of Sehat, you do equity accounting. Okay, it means share the profits. Okay, now we know what the question was for first part A first. So you want the P&L, SOFP, and Sehat is a significant influence, so Sehat is an associate. So now go to the full questions. So Puncak acquired 25% share on 1st January. X1 2022. So this they bought it. Okay. So and on my right here, so I put it on a chart format. So 1st January 2000 X1 associate 25%, they pay 2.20 billion. When Sehat reserve were standing at 5.8, so this will help you to compute your whole acquisition profit, so you can share 25%. Any profit above this 5.8, so after 1st January X1 profit made by Sehat, you can share 25%. So this means equity accounting. So fair value of Sehat identified asset liability equity 7.2. So this is the assets. They have net asset, okay, asset. Okay. So this net asset, when compare the net asset in future, so the difference will be post-acquisition. So you can share 25%. Remember, we have two methods of doing console. One, you're using the task 1, task 2, the one we compare the net asset of at their acquisition, at consolidation. So find out the post-acquisition profit. So at 31st December X1, okay, the first year, so he bought fair value of 25% stake of Sehat is 2440. Okay, this is the value they're telling you. So this will help us to determine. So if they bought at 2.02, now become 2440. So obviously they make some gain if they sell it off. So then in this case, a further 35% stake Sehat was acquired the 30th September in X2. After 1 year and 9 months, they bought another 35%. So initially got 25, they bought another 35% on 30th September X2. 9 months. That the year end 31st December. So 9 months the time they bought it. So in other words, in X2, first 9 months is associate. Balance of 3 months are subsidiary. Okay? 60% subsidiary from 1st October onwards. So be very careful on the date. So this is given in the timeline here. Okay, in green color. So follow this is critical. Okay, they bought under 35% at 30th September 4.02. So this amount then we use it to compute goodwill. Okay, so because they reach control already, so they from a associate becomes subsidiary. So the goodwill computation as shown here, consideration transfer 4.02. Okay, so your 35%. So the previously held share, how we're going to evaluate 25%? Okay, we come to that. So we put in the, so you put in terms of task here. So we pay the here. Okay, now we can draw up. So put in the percentage here, easier for you to follow. So previously they have 25%. Now they bought another 35%. So in total you have here you have 60%. So your NCI will be 40%. So you can double check, you add up these three to 100%. Okay. So when you pay you bought the 35% on 30th September, you pay 4025. So 4025. So you must now you find out previously how share 25% how much, NCI how much, and the share capital. Okay, they said then at the fair value of 14,375. So this fair value is at 14.375. Now you can find out the previously held share fair value how much. So you go to Sehat share capital. So $1 each, so about 800 million share Sehat. So then you can compute here, you have 800 million share. So previously held 25% at 14,375. So you get your 2,875. Follow. Okay. So I repeat, previously held share is held 25%. So the total Sehat share got 800 million, 800,000 times 25% times the market price of $14,375 here. So you have previous held share. Okay, we go to come to NCI, we'll see how the NCI accounting treatment is there. Okay. So giving Punchat control over Sehat, they mean this is a subsidiary. The fair value identified asset and liability at that date is 9,004. So Sehat reserves stood at 7,008. So they mean the whole fair value, the whole asset liability here, they told you, give you a lump sum. Very kind. They tell you, hey, this whole thing add together, net asset is 9,400. Okay. But they say the reserve stood at 7,008, the reserve here. 10,800 reserve. Share capital 800. So you realize that you add out these two reserve and the share capitals, you can't get your 9,004. Different here, 9,004 and 8,006. So we come to this, okay? You see what the questions say about this, why they have a difference. So for consistency, the measurement of other reserve, Punchat hold all investment in subsidiary associate at fair value through OCI. Mean any change in fair value, go up or go down, you just debit or credit to OCI. Okay, let's suppose 1 million investment, it become 3 million, increase in 2 million, then you credit OCI. This is what I mean by fair value through other comprehensive income. So we will learn more about this when we reach to the last chapter, MFRS 9. So the consolidation prepared period MFRS 10. So at 31st December, fair value of 60% holding is 702. 60% they are holding. Okay. So then they give a cumulative gain recognized in Punchat at 970. So this is at Punchat separate financial statement at Punchat level, not at control level. So Punchat can recognize gain. Okay, fair value through OCI. So it go up in value. Okay, so recognize 975. The question tells us. So this gain must be eliminated. It means cancel off at control level. Okay, we can't recognize this gain. But this is only in Punchat separate financial statement. So we come to that. So they've given you the SOFP of two companies, Punchat and Sehat. Give you the P&L, Punchat and Sehat. So now when we do a console P&L here, the Sehat one, we only can share 9 months. Because the control income in on 30th September. 1st January, 30th September, 9 months only. Okay, for associate, and 3 months for subsidiary. So 3 over 12 is for subsidiary, 9 over 12 is for associate. So it sounds complicated. Eh? So in terms of a timeline, you can see here, I draw here. So 1st January X2, this is an associate, so equity account 9 months. Share per action profit. From 30th September to 31st December, it becomes a subsidiary for 3 months. So using subsidiary acquisition method, that's why from 30th September, we compute the goodwill. Yes, continue. So now they tell us the difference between the fair value identifiable asset of Sehat and the book value related to plot of land. The land has not been sold, so still with the group. Oh, then now we know that this is the fair value adjustment for land. It's a land. 800. Now you found the difference. They told you the difference. Okay. So in this group here, we haven't found the NCI, how they compute. So in this case, they said income expenses assume accrue evenly. It means you have to time apportion the expenses and income. 9 months associate, 3 months subsidiary. So they don't pay any dividends, so make your life easier. So you know to cancel off the dividends. So Puncha elect to measure NCI at the acquisition at fair value. It means the share price of subsidiary at date of acquisition. So we find out there are no impairment, losses, no impairment of goodwill, easier for us. So what the price at the date of acquisition? So they just told us here, 14,375. Highlighted in red here. A further the decision was acquired in September, 13,375. So the 40% here, okay, so we have 800,000 share in Sehat. So we NCI share 40% and 14,375. We got 4.6 million. So we have goodwill of 2,100. Okay, up to here, any question? Goodwill.
I still cannot understand why the fair value adjustment land is 800.
Okay, so you go to the question. The question told us. Okay, so first you see again under this paragraph, so a further 35% stake in Sehat acquire. Okay, they say the fair value of assets. I think I just delete this. I believe it's 9,400 or 9.4 million. You see, they told you all the asset liability 9.4 million. So reserve is 7.8. The clear. But when they add up, we know net asset is share capital plus pre-acquisition reserve. But it can't reach 9,004. Okay, without this. So that has a difference. So reserve and here you add up. 8,006 and 9,004. This is a difference. So they said, then they will tell you the difference between the fair value identified asset liability, 9,004, and their book value, 8,600, relate to value of plot of land. So now we know that this actually is land. Okay? Understand?
Understand. Thank you.
Yeah. Okay, good. Tomorrow you can still watch the video, it follows. So in other words, remember when an associate or investment become a subsidiary, so you might print the highlighter in blue here, previously held share, how much? The rest are the same, goodwill computation. Okay. So now the question says 25% here is equity accounting. Okay. So we found out is how much share we can share the profit, 25% equity account. So in the P&L, we'll P&L first. So you have using the profit before interest and tax, so 100% of subsidiary of parents, Punchat, 1280 plus 423 over 12. So you become subsidiary on 30th September. So you get 1385. So finance cost, same thing, 80 plus 20 over 3 over 12. These two add together. You get 85. Okay. So now we have this called the share of profit of associate. First, I'll go to that. Okay, that recognize investment. So I go to working 7 first. So where is the working here? Okay, it's here. So remember, we know that the fair value of previously held share, the 25% ones, is 2875. So from here, okay, 2875. 25% 800,000 share at 14,375. Okay, previously held share. But we know that this is an associate, so you only can share the equity profit. So the time we bought the time number on 1st January X1 is 25% 2020. Okay, it means 2.02 million. Then we can share 25% of the profit here. How to share the profit? So you compare the net asset 7,008 with the 5,008. So the reserve were standing at 5,008 on 1st January. Okay, fair value asset at the date with 7,200. So 5,008, then it subsequently increased to, so the SEHAT reserve stood at 7,800. So the difference between 5.8 and 7,008 in 2 periods is because of the increase in profit. So draw the timeline for you. So when we bought the 25%, so it's on the 1st January X1. So the reserve or retained earning, RE, is 2.02 million. So now, by the time we become a subsidiary, so here to here is the associate. So after this, it becomes subsidiary, you can't share. So at this stage, the reserve is 4.8 million. So how much is the post-acquisition? If difference between these two, then you can share 25%. Follow? Just like you must know the net asset, the change in net asset because of change in profit. So 5.8 minus 5, 7.8 minus 5.8, you times 25% plus the original cost, equity accounting, you get 2,520. Compare with previously held share, 2,875, so you gain of 355, so you charge to the group retained earning or your P&L. Both. Okay. To here, clear. How to get 355? So your previously held share how much? But here we have to do one more work because equity accounting for SEHAT. So you pay 2,020 plus the profit of 25%. Remember equity accounting. So the profit you compare with 7.8 minus 5.8. 7.8 is at 30th September. 5.8 is at the time first time you bought the 25% interest. So we use the 5.8 here. But 7.8, the difference will be your post-acquisition profit for the 25% you can share when still a subsidiary from 1st January X1 to the dear September X2. So remember equity accounting, I just explain to you one more time. So equity accounting is cost of investment. 25% you pay 2,020 20,000 plus post-acquisition profit. But this time you can share 25%. How much post-acquisition profit? With 7.8 million minus 5.8 million times 25%. Because the changes between the two between earning here must be in the profit. Share capital constant. Okay? Then you share 25%, you will get your, okay, just show to you, 7.8 minus 5.8. So it's 2 million times 25%, 100,000. So it's 2520. So the fair value just now we computed 2875. So the difference 355 is the untung gain. Because remeasurement gain. Okay, now. So when you associate becomes subsidiary, you have to do one more step here, the equity accounting, because the associate must share profit. So your 355, you put in the group retained earning here, talented group. So your sehat, you must portion your profit, the 25% profit, interest, and the 60% when you start from 30th September. Get a portion out. So you get 100 here, 60%, you can confirm it with the P&L here easier. So 400 here, the profit of sehat. So 3 months is how much? 3 over 12 times 400, you get 100. So the rest will become sehat, 2,000. So just how we confirm the 2,000 also. 7,008 minus 5.8 minus 7.8 minus 5.8, 2 million. So same as what I mentioned here, 2 million. And 25%, you get 500. Okay, up to here, any question? Or don't know what to ask. Okay, don't worry. So then you get 2 million here and we share 25%, 500 just how we have computed. But subsidiary, you share 60% and NCI 40% of the 100. Okay, so the 975 now you have to reverse it out from the profit here. So that's why you minus from here because it's fully recognized at Puncak financial statement only. Under we charge to OCI, so we must take it out. Okay. So the NCI acquisition 4.6 is how you computed when you compute the goodwill. So for the balance of 3 months, you can share 40% of the profit. So mean 100,000, 40% of it, 40. 100,000 out of the 400. Okay, 3 over 12 of the 400. So the fair value adjustment 800. So just how we have computed the balancing. Now for P&L easier, just add across, recognize. So income tax, parent plus subsidiary. So the booking 7, I'll show you subsidiary under booking 7. Revaluation gain, same thing, parent plus subsidiary, but make sure you're going to share 3 months only. So same thing when we do the profit, so we copy down the profit first, then compute NCI. NCI 32 times 3 times 12 times 40%. Okay, NCI on the profit here. So 320, 3 over 12 because it's in 3 months. For total comprehensive income, use of 400, 3 over 12 times 40%. So the balancing will be profit for the owners or parents. So the B balancing. So let me show you the working 7s. So any other questions? So don't worry, it won't be so complicated in the SM. Okay. So this here will give you the full working solution here. Let me see anything I miss out. Okay. Now this now is type 2. Now we go to type 3. So when control is retained, so we forget about disposal acquisition where control is retained. Okay, and the types. Type 3 now we have, so we have a subsidiary already. You buy more share. So the right control retained is still within your control. Okay. So this type the treatment are different. So you not need to compute goodwill because you have computed goodwill when you first gain control at 55% in this example. Okay. Now we go to this 2.1 here. So when you compare how you calculate, so when you buy another 20%, you must pay money for the 20%. Right? So when you pay money the time, so you pay cash, you credit cash. So you defer payment, you pay later payable. So credit here. So when you buy from increase of 20% here, so called NCI will go down. Right? NCI go down inside credit balance, so you debit NCI. 20% of NCI here. So the difference you go to OCE. This is the accounting entry. So other comprehensive income, not to P&L, OCE, other comprehensive income. Because the standard said this is a movement between two owners. Owner mean the parents and NCI only. So when we do console the same, whether 55% or 75% goodwill the same, share of net asset the same, parent plus subsidiary. Only the NCI change and the OCE change only. So this is the main entry you need to know. Okay. So this one is same with the one highlighted here. Let's come with the example like here. The fact is the same with the 1.4. Now we have the Sehat at Punchat one. So the NCI reserve at Punchat, they buy an additional 10%. So they already have 60% plus 20, 80. Now they buy another 10%. So remember, just show you the movement, just how the Punchat one. Sehat, so we have 20%. They bought under 60%. Now they buy another 10%. So here you already have 80% rate. Go back to the first one. 25, the time you are 60, now you buy another 20%. Yeah. Sorry, another 10%. So means 60% subsidy, bought another 10%, you got 70%. So this is type 3 retain control. So in this case, what you need to do is compare, say they're paying for 1.2 million. So you pay 1.2 million as the example I given to you. So you just put, you pay 1.2 million. 1.2 here. Okay. Then NCI, the 20% is how much? So if I, because then we compute the NCI here, NCI acquisitions. So we got 4.6 million using fair value. So share a profit of the 40% of it by NCI, 100,000. So you got 1 year of 400,000. So 3 months is 100,000, 4% 40, so you have 4640. So this 4640 is, put the NCI here. So listen carefully. So this 4640 is 640 is equal to 40%. So 20% how much? So divide by 2. But in this case, they want to buy 10%. So 10% you divide by 4. So you get 1160. So you debit 1160 of NCI. So the difference between these two are 40. So you charge to OC. Okay, this is a type 3. Okay, don't worry, we give you more example of type 3 ones.
May I ask why divide 4?
The 40% of NCI is 4640, correct? So with 10%, how much? So divide by 4. Agree? So you divide another 10%. Understand? Okay, I'll tell you, make it simple. Okay, if 40% equal to 4,000, 10% how much? 4,000 divided by 4 equal to 1,000. Agree?
Yeah, agree.
Oh, same thing here. 40% equal to 464 divided by 4 is 1160. Understand?
Understand.
Okay, this is standard form 3 mathematics. Okay. Don't worry. Now we go to. Okay, this. Remember with P&L 1, we give to you P&L 1, P&L 2, the worksheet. So same thing. That remember the first P&L we have P acquire 75% interest in S. Okay. And they give you the P&L here, P call and S call. And the different X6. Now I put additional information in clean color. For step acquisition on 30th June, P call acquire a further 5% interest in X for consideration 30,000. So they pay 30,000, they pay cash, so credit cash 30,000. Right? So this is type 3. So you really control 75%, you buy another 5%, you got 80%. So then you must find the NCI is how much first. Okay, so when we do the console, we know our revenue as 30th June X, it's the middle of the year. But we don't care, we just get parent plus subsidiary. Revenue 75,000 plus 38,000, you get 113,000. So cost of sale, parent plus subsidiary, 30 plus 20, 50. Admin expenses, 14 plus 8,000, 22. Tax, 10,000 plus 2,000, 12,000. So you get 29,000. Now you file the NCI. So you know that first 6 months of the NCI is 25% because you bought 75%. Okay. When it comes to 30th June, they bought another 5%. So NCI dropped to 20% from the second 6 months, 1st July onward. So they use 8,000 times 6 over 12. 25%, 1,000 NCI, and second 6 months, 1st July onward is 800, so 1,008. Okay, so 1,008 you put here, do the balancing, come to here. So NCI is 1,800. So now you see the 5% of the NCI is how much? So we know up to here is 1,000. okay, for 25%. So divide by 25 times 5, 200. So this is NCI at the beginning, okay? So this is we wanted to do this because they haven't give you the good view. So the NCI acquisition not given, so you can't compute the 5%. Okay, give you one more example. P&L 2. So this is type 3. All this we answer one. So one more additional information. Hi, clean one. So P acquire further 10% interest in S for cash considerations. At 30th June, so your portion up, same thing, the 40,000 here. Okay, at 30th June, you end at 30th April. So then, in other words, under here, we need 2 months is 20%, 2 over 12 months. But you end at 30th April. So only May and June will be 20%. So the other 10 months is 10%. So you bought another further 10% from S. So the NCI will be 40,000, 2 over 12, 20%. So 40,000 here, got 133. So the remaining NCI is 10%, 10 over 12, 10%, 333. So in terms of journal entry, they pay 4,000, you credit bank or cash, 4,000. So NCI at the date, 4661, 466. So the difference go to OCI. Up to you, any questions? So let's we do some online questions. So you're not sure how to do, then we can discuss, okay? Let me share with you. Give me a minute. So I give you the link on the online questions. So please try out so we can discuss this. Okay. So the first one is basically on the step acquisition where you still retain control. So you try to open your link I sent to you. So can you see this? So here I give you the explanation where acquisition sub to sub. This is type 3. You really have control. So you need to have consideration pay where you always credit whatever you pay. And you minus the decrease in NCI because you buy from NCI, increase it. So the difference go to equity or OCE. OCE means equity. As simple as that. So in the P&L, you have to do the full consolidation because it's still your subsidiary, whether 50% or 99%. So NCI, the OCI pay on percentage after and before acquisition. Okay, I given here. Okay. Okay, proportion share. Okay, I'll just better go back to here. So there's no change in profit and loss on the second acquisition. So remember, this is a NCI only decrease, and the goodwill is unchanged only when you compute your first time you've been controlled. Here they give you the subsidiary, the consolidation format. So you compute your NCI at acquisition date, then you share the profits up to the date your first step acquisition. And then decrease you proportion out. This is how the guy asked me 40%, why you divide by 4? So you've got 10%. You 20%, 40% you divide by 2. Proportion out, percentage of you purchase divided by the NCI before the step. So this is the formula. Just now we purchase 10% addition. So existingly we have 40. So 1/4, you times 1/4 and divide by the 4 are the same. Okay. So then you minus the decrease, the one is 10% one, you get after step acquisition. Okay, can you try out this question? So we will discuss. See what time we discuss. So you are given okay, we take a break. We come back at 12:40. In the meantime, any questions? So here the very simple one. So ask you to compute goodwill impairment of goodwill first. Then before you come to the difficult one, 60 to 70% entries. Okay, so this will help you to understand better. Okay, you try this out. You're not sure you can read the mind map here and the explanation note here. You cover all the important part of the step acquisition for sub to sub. So it's step type 3 console. Okay, can we discuss the online questions? We discuss the online questions. So now this one is the step acquisitions, where is this subsidiary to subsidiary. So then you subsidiary, then you do have the fair value of previously held. But we just hide this. So goodwill impairments, done correctly, okay, using full goodwill method. So first of all, we do this is you might find out. So we draw a simple group charts that I was showing here. So P acquire 60% on 1st January. P acquire 60% for 72 million when market price of S per hard share is $2. So in this case, P acquire S. So on 1st January, X7 60%. Then on 1st July, X7 another 10%. So a total of 70%. So this one then is subsidiary to subsidiary. When you have 60%, you already a subsidiary. So it means subsidiary to subsidiary, we call this retain control. So when you retain control, you need compute goodwill. First, you gain control. Then subsequent addition, no changes in goodwill. No need to compute any more goodwill. One time only. So now you compute goodwill at compute goodwill GW when you reach at 60% level. Then you stop. So then is it mean on 1st January they bought 60% here? 60%. So they pay how much? 22 million. 22,000. Okay, all in millions. Then is it? So adopt partial goodwill, but the question asks you to compute using full goodwill. Question 1. Full goodwill means NCI at fair value. So share capital of S is, as given here, 60 million. On 1st January, so they give you the P&L of you ended 31st December X7. So 1st January will be early of the year. So retained profit at 31st December 20,000. X6, you have to compute the 1st January profit, you'll be at 9,800. So you the 20,000 here minus the 10,200. So you the 20,000 accumulated minus the current year profit. So you get the opening 9,800. So this is your, so no fair value adjustment. So what you need to do is to add up both. So minus sign here. So because the question asks you to do full goodwill method, so you have to use, so 40% of NCI. So the share capital of the subsidiary is 60,000 times 40%. What is the value? On 1st January X7 is $2. 5020. So the impairment 10% of the 5020, 200, you mean 5020. Up to here, any questions? So your impairment 10%, so will be Jiayan, you do it correctly. So for impairment using partial goodwill, then you need to compute this 40% of 69800. Okay, and that. So you get 30120. Okay, so impairment with 3012. So everybody follow? So goodwill is how we
How to get the retained earning?
Okay, so current year profit how much? P&L for SBR how much? 10,200.
Yeah.
So cumulative profit at 31st December is 20,000. So the difference will be opening. Okay, I'll draw a line for you. Okay, so this is 31st December X7. So cumulative with 20 million, 20,000. Okay, whole year here, P&L is for 12 months. Is 10,200. So how much is here? 1st January X7. How much? You 20,000 minus 10,200, 9,800. Understand?
Yeah, I understand.
Okay, good questions. I think a lot of students still to know. To know, just ask. Okay. So full goodwill, partial goodwill. Group profit after taxation. So a bit complicated. So you have to do all the full step. Okay. Because you have to compute the impairments and the operation expenses. I think your mistake is you didn't take out the impairment. Jiayan, do you know why you different your group profits after taxations? Yeah, 3012. You forgot to deduct goodwill impairment. Jiayan, can I speak to you? Jiayan. Jiayin. Can I speak to you? Okay, basically he's missed the difference here because of the impairment of goodwill. 3012, you have to charge to P&L. These are expenses. So NCI, this must be careful because it's the NCI as given here. So the chart here, let's say I draw in red. So 1st January the time, X7 to 30th June X7. So it bought 60%, so 40%. But from 1st July X7 to 31st December, X7 is so it bought another 10%, so become 30% NCI. Well, because the parent bought addition 10% in 1st July. So from 1st July onward to 31st December, NCI dropped from 40% to 30%. So then you have a portion of whole year profit 10,200. First 6 months, 40%, 2040. Second 6 months, second part, 30%, 1530, add together 3570. So you must get this right. Okay. So you can use this method. This is proportion to the net asset we use. NCI acquisition. So share of profit, you have two portions. First 6 months, 2040, then 6,530. Okay, so you just add up this. So profit attributed to the parents. So you use the total profit here. Okay, you minus the NCI. Okay, like given here. So 1198, this is computed, you minus the NCI. So you get balancing of 8418. It's given here, okay? Chia Jae-yen. I speak to you, Jae-yen. Then he's having lunch or what? So the addition 10%, how are you going to charge? So 10%, they bought another 10% on 1st July, isn't it? So they're paying 50 million. So you will credit 50 million. So NCI will drop by 10%. So NCI here is 40%, drop 10%, they are by 4. So until 1st July, the NCI will be 1st July 20 X7. So this is 40%. So 10% how much? Just how we're using the same formula, they are by 4. So additional 10% to purchase the parent. 10% here, you just minus from here. %10 is equal to by 4. 7490. So your double entry is, so you credit payable, so you say by a 10%, they're paying 50 million, right? So your NCI will reduce by 10%, NCI. So 10% here is 7490. So the difference you debit to OC, other comprehensive, other component of equipment, equity, 7510. Jia-yen, where are you? Can I speak to you? It disappeared. So the rest can submit. So the double entry I given here. So it's basically didn't do. Okay. Credit payable, debit NCI 10%, and debit OCE. A lot of students didn't even try out. So this will come out in your midterm. You don't try out, you look here. So that's why a lot of people fail because you don't even try out. Okay. And those fail one are less than 30 marks one. Maybe more than 30 marks, we try to help you, give you some additional marks. Okay, let's continue with other things on another example for you. They give you a much more comprehensive example. So this is on your okay. So this the question here, example 1 here. So in your question step acquisition example for lecture. So this is a past midterm exam. Okay, so they given here Rakan and Sabat. P&L for 2 companies. SOP for 2 companies, year end 31st December 2020. So they give you additional information. So Rakan investment in Sabat was acquired for a first, initially by 40% on 1st January. This is what? This is an associate. So 40%. Okay, so Rakan, the right chart here. Rakan acquire Sabat. So initially bought 40%. 1st January 20. So you need to do equity accounting from 1st January 20 until he bought another 15%, 1.5 on 1st July 20. So you have 55%. So then you do console now. To console, you compute the goodwill, NCI, and group retained earnings GRE. And your previously held share 40% must be fair value at 1st July 20. This is the step. Because this case is associate, step 2, type 2, associate to become subsidiary. Associate to sub. Okay, now you understand all the question. They give you all the fair value. So the fair value for the previously held share 40% will be $10.50 when you gain the control 1st July. Okay, at 1st July it will become $10.50. So you see here, obviously you make some money here already, $2.50 per share. So second note, profit are deemed to be equally, so you can do time apportionment and profit because they acquire in the middle of the year, 1st July. So first 6 months is associate in P&L. Second 6 months is an 55% subsidy. So 45% are NCI. So this case, NCI. So NCI is 45% from 1st July 20 onward. Okay. So this one you do equity accounting. You share the profit. So that's why I keep on emphasize must know the previously study how to do equity associate, how to do console for normal goodwill. Okay, NCI group retained earnings. And you say NCI using fair value method, so this is the full goodwill method. So they ask you to determine the profit and loss remeasure of previously held share. It means the previous 40%, how much? So now 40% here, you bought at 9,006, now increase at $8, now increase to $10.50. How to do it? Part 1. The previously held share, how much you make. So from here, then we know that we have 40% share of 3 million. Because here, Sabat got 3 million share here, 1,000. So 3 million share. So previously held 40%. So now the price on 1st July 2020 is $10.50. So you get 12.6 million. Follow. You cannot follow, let me know. Huh? Don't wait until last minute, sir. I don't know what it is. Okay. Then we have to compute equity accounting until 1st July 2020 to share the profit. So cost of investment you are paying here is 9,600 for 40%. So we can share the profits. So the profit whole year is 12 million. So 6 months is associate, 6 months is a subsidiary. So there you have 12,000. So 6 months, 6 over 12 times 40%. So you get 2.4 million. So you sum up this thing. So the previous house share, you minus it. So the difference. So 600 is the remeasurement gain of previously held share. Can follow? Okay, so this is when an associate become a subsidiary type 2. Okay. So this one is more complicated because you must know how to console associate, how to console subsidiary. So more complicated. You have to compute the remeasurement gain previously held share. So for the goodwill computation, so they pay 15% consideration. So they pay 4,725 here. So just said 4,725 as per question here. So your remaining share at fair value, just I already computed 12,600. So NCI at fair value mean at $10.50. So 3 million share times NCI own 25%. Okay. Then at fair value, $10.50. Up to here can follow. Give time for you to digest. Okay. Then let's continue. Then for the net asset easier acquisition date. So equity share for the subsidiary 3 million. So your profit must be computed up to 1st July. So 1st January profits. So you have 12,000 here. Retain profit 1st January 10,000. So then here 6 months you 6,000. So 16,000 you can put here 10,000. 12,000 a year 6 months will be 24,000 times 6 over 12, half of it. Oh, 12,000 not 24. $10,000, 6,000 here, 3,000. So your goodwill is 12,500. So delete this, confuse people. So if you follow, you get to 12,500. So now we go to part 2, compute goodwill you have done. Number 3, requirement, prepare consolidated P&L. So P&L is a parent plus subsidiary. So the parent here 60,000 plus half of the subsidiary here, 38,000 here. So 38,000, half of it, 38,000 times 6/12. I just add the cost. Okay, cost of sales, same thing. 30,000 here. So half of it, 10,000. Cost of sales is expenses, put negative in front. So you can do the rest. But if put in the new thing here, in remeasurement gain on the 600,000 here. Share associate profit. So your 12,000 times 6/12, you share how many percent? 40% associate profit. 1,004. So 600. So these are profit. So the rest add the cost. So operating expenses 4,000. So you get 2,000 here. Finance cost 0, nothing. Just add the cost. So get cost of sales. Profit before tax. So taxation 2,000. So you get 1,000, half of it. So you get the cross. Just use formula easier. Okay, so you copy it out. Then your NCI 6,000 for half year and 45%. So only second half of the year becomes subsidiaries. So it's a balancing for parents. Okay, console P&L done. So look very easy, isn't it? Look only. So SIP, you can do it on yourself. Okay, you copy it. Goodwill already have it. Have you? You have computed. Here, 12,000. Goodwill is given here already. Okay, P&L 26,400. Okay, so these answers are given here. So you can alternate using the group retail ending NCI to compute. Okay. So after all, not so difficult, eh?
Not sure.
Which one? Not sure. Are you talking to me?
Yes, sir.
Which one? Not sure.
No, just how to say? The current profit year,
12,000, 12 million. Arrow.
$12,000. Not, I saw it's 6,000.
Yeah, because we become subsidiary on the 1st July. So you only can share 6-month profit.
Oh, okay.
Okay, that's why I put 6,000 current year until 1st July onward. 6,000. You complete your pre-acquisition up to 1st July. Right? So opening profit plus current year 6 months and 19. That's why the date is very important. That's why I always write down the date one myself. Okay, you won't which date it becomes subsidiary. You mean the date of acquisition. Okay, milestones submitted. Let me see. Wow, disaster, this one. Would work out 4/17. Okay. Same thing. I consider good already. This one is Su Ying. Call Su Ying. Can I speak to you? Call Su Ying. Call Su Ying. My friend, I will speak to your no news. Even you can't speak your microphone, just type in meeting chat. Sorry, sir, cannot speak. Okay. It's like when I teach, I'm at least half of you some thinking doing something else and wasted my efforts. But hopefully you go back and watch your video. Okay. Okay, try to pinpoint your mistake. Where is it? Okay, that's why I give you online questions. So you can't speak to me, tell me. Okay. Fanny, I'm sure you're here. Fanny, can I speak to you? Fanny,
yes, sir. Yeah.
Okay. So you know why you make mistake here? Composition of goodwill and consolidation using full goodwill method.
Yeah.
So where have you gone wrong? Or using the 31,000, I think is using partial goodwill compared to full goodwill. Okay. Full goodwill, you read the share price of the subsidiary. 60 million times $2 share price at 40%. So your 31,000 million one, you're using a partial goodwill.
Okay, sir.
Okay. So read the question carefully. 10% one, you get 7. This one is a bit complicated. Okay. So you need to compute the NCI up to the day of disposal. In this case, is middle of the year. Okay. 6th of June. So you get opening NCI plus the post 6 month 2040, you get 29960. Then this is 40%, 10% of it. So divided by 4, you get 740. Compared with the 50 million you pay, the difference, you go to the OCE 7510. You better know this, you come out in midterm. Okay?
Okay, sir. Yeah.
So the double entry 1 correct. But NCI, what is the normal balance of NCI, if any? Debit or credit?
What is it, sir?
Normal balance of NCI, debit balance or credit balance? NCI is equity, but only thing not belong to the parent, belong to other non-controlling interests. Is it normal balance or debit or credit? NCI.
Actually,
credit.
I accidentally click to credit. Should be debit, right?
Yeah, it's credit. We want to now we buy from NCI. Now NCI reduce already.
Oh, okay.
So reduce, you have to debit it. Okay. Okay, so that's your debit. When you owe people money, is debit or credit?
Own people money.
Yeah, credit card.
It's
Now,
credit.
payable credit, not debit credit.
Okay.
Okay. Better know this basic thing, logic or this thing when you next time you come up to work, whether you audit or you work in accountant, then your staff ask you, oh, yeah, I owe people money, debit or credit. Then you also let me Google search first. Okay. Okay, thank you, very.
Okay, sir.
Okay, so more of you still need improvement. I think look for something very easy for you to do. Or this one. Shorter question for you. Tutorial 1, tutorial 5. Let me look for some. Okay, this is individual question. That's easier. So try one more this online question I will send to you. So try this, then we will discuss. So I saw your mistake. I know where you don't understand or misunderstand. Okay. So like here, I give you a story. I hear, I forget. I see, I remember. I do, I understand. You don't do, you don't understand. This is advanced accounting. Okay. So now I give you summary note beside that. So 10% shareholding to 80%. So this is a type 1. Okay, you gain control. So they tell you what to do. So you have to remeasure your previously held share. Okay. So you control the subsidiary from the day it become achieve the control. And if we associate to subsidiary, just our case, okay? So remeasure the associate at fair value at date the parent obtained control, which is 1st July 2020, okay? You have the equity account associate up to the date that the parent achieve control. So all this give you guide. So yeah, this one the easier is individually, each case, okay? So that you can test you the basic things. Okay, 1, 2, 3, 4, 5, 6 questions only. Okay, 6 MCQ. Okay, try this out. I'll give you 12 minutes to do it. To 6 questions. 2 minutes for 1 question. Discuss at 1:30. Okay, let's discuss the online questions. Okay, first question here, JC. So when you read this type of question, you ask yourself which type of step equation, step 1, step 2, type 1, type 2, type 3. Is it retain control or lost control, whatever? Okay, so in here you can write down the simple chart. So JC, okay, acquire GH 60%. Or you already subsidiary already. Okay, years ago. Okay, several years ago. NCI measure of proportional to the net asset, so this is partial goodwill. On 31st December, acquire another further 20%. So you get 80%. So in this case, sub to sub. Okay, subsidiary here becomes subsidiary. So in order to compute goodwill already, when you acquire the addition 20%, okay, so your NCI from initial 40%, reduced by 20%, become balance of 20%. Okay, 20%. So they buy another 20%, 3 million. You buy something, you have to pay. Okay, so you pay, I think go to your bank will be credit. You pay for 20% out here, 3 million. So your NCI go up or go down? Go down. NCI credit, so you debit NCI, credit the bank. So NCI, 20% of it. So the net asset is 40 million. So 20% of it, you will 2.8 million. So the difference 0.2 million is on the debit side. So you go to OCE. As simple as that. So first thing you must get, this is type 3. Console, sub to sub. So it's just a movement between the owner, NCI, and the parent only. So you can't charge to P&L the 0.2 million. Any question up to here? This question. So the double entry is, so you credit the bank because you pay. So NCI reduce, you debit NCI. So the difference go to OCE, not group retaining, not affected. NCI 3 million is wrong, not affected. Yeah. One submitted, see who it is. Tan Yan Yi, can I speak to you? You will, Tan Yan Yi.
Yes, sir.
So what happened to this last one? Compute goodwill and consolidations.
I got input the SBR.
Can I speak slightly louder a bit?
Sir, can you hear me?
Oh, okay, yes.
Yes. For the goodwill computation, I got input the fair value adjustment.
Oh, fair value adjustment. Okay. So you understand why,
Yes.
Good. Well done, very good. And you understand all the very well. So are you taking any ACCA question paper?
I plan to take one this December.
What subject?
SBR.
Good. So these are very relevant to your SBR, okay? Okay, thank you. Let's go to question 2. So in this case, AB acquire 10% of CD. Same thing, you can draw out a chart here. So you redo it. Let me cancel these things first. Okay, I better draw a simple chart so that it's easier for you to follow. So AB have 10% of CD. So this date 1st April X0. So you can expert in order to draw this out, okay? So you pay 1.6 million. So here is a trade investment. So now you do anything. You can't do equity accounting because it's less than 20%. Okay. So on 1st January X3, they acquire another 60%. So you buy another 60%. 1st January X3. Now you become subsidiary, 70% subsidiary. So your NCI are 30%. So this is what type 2. This is investment become type 1 and type 2 become subsidiaries. So you have to compute goodwill at 60%. So goodwill when you reach the 70%. So the 10% remeasure at fair value. So any gain loss charged to P&L. This is where the investment becomes subsidiary. Okay, so they buy another 60%, they pay a cost 10.35 million. So they bought 50%. So previously they have 10%. So the NCI should be 30%. So you get this right. So you buy the 60%, you pay 10,350 IU in 1,000. Okay, so retained earning 4.8 million. So they got 10 million share. So share capital will 10 million. So now we know the previously held share 10% fair value at how much? The fair value, then they tell the fair value original 10% investment, 2 million. So very nice, 2 million. Okay. You know to compute. And they told you NCI 5.4 1st January. Okay, very nice. They told you also 5.4 billions. And value of goodwill. How much is the value of the goodwill? Okay, be 2,950,000. So everybody follow. So this way, it's very nicely objective to tell you all the numbers, and so you must know the framework calculations. So fill in the blank. Up to you. Any questions? Okay, let's go to another questions. Okay, now this one. First, you ask yourself, is this a subsidiary or investment to subsidiary or associate to subsidiary? Okay, you read out the question first. Let me delay all these things. Okay, they say TK owns 70% of GH. So this kind now cover TK own GH 70%. 31st December X2. So they buy another 20%. What type is that? This is type 3. So subsidiary to subsidiary, subsidiary to subsidiary. So you got 80%. So then you compute goodwill at 70%, 70. Then you stop there, no change. Then the 20% you buy is the movement between the owner. So you just pass the double entry, you debit the NCI. Okay, credit whatever you pay. So now this time they're testing you the existing NCI is 300,000. So you buy another 20%, you pay 320,000. So which of the following statement is false? Incorrect statement. For additional of 30% equity interest. Goodwill on acquisition unchanged. Yes, correct. So unchanged. The 70% still there. We reached compute at 70%. Addition 21, 22. I think this is a bit of typo to be 20%. Let me change the this is 20%. Okay, so mix up. So goodwill unchanged, correct? Okay. Goodwill should be recomputed. This is wrong. You don't need to recompute goodwill at 80%. Okay. So different to 20%, the payment charged to OCE, yes, correct. No gain loss, yes, no gain loss because it's charged to OCE. Why they don't give you gain loss? Because you're still controlling the subsidiary. You can do whatever you want. You can sell whatever price to make gain or make loss up to the parent. The parent are controlling you. So, I mean, this transaction is basically not an arm's length transaction. That's why the standard doesn't allow you to recognize it in loss to profit and loss. Okay. So then in theory, you must not have to write all this point here. Okay. So this is subsidiary to subsidiary. So goodwill is unchanged. Okay. You go back to the original goodwill when we first gain control at 70%. So the 20% and the payments will charge to OCE for this point. Okay. Next one, TK owns 70% of GH equity share on 31st December X2. So if I add further 20%, so same with what you have. Now they're asking you what is the amount charged to OCE. Okay. Now they say, okay, now we can pass the entry. So when you make payment, you credit. Okay, you make cash, you credit cash. You're still owing, so the 20% of it. So they're paying 320. So then they will debit NCI on the 20%, how much? So the existing NCI is 300. 300 meant we know 300,000 here, we know this is 30%. So 20% of it will be 30% over the 30%, so it will be 200. So the difference will be debit to OCE 120,000. $100,000. This is 200. So the 120,000 here. So here make some changes here should be 320. 120. Okay, make some changes. You can reload it, and they will mark for you. Okay, reload the online questions. Any question up to here? So that's why each question you must ask yourself which type of step acquisition they're testing you. Okay, so all the three types, accounting treatment you must memorize and understand how to do it. All the step. Okay, so the easier one is subsidiary to subsidiary, we call it retain control. This is the easier one you test in your midterm. Okay, I don't want to kill you. Okay, so make sure you know. Understand, okay? Any question here? So we do one more. So in this case, they ask you the double entry. I already given to you here. So you pay 320. Go to OC, you'll be 120. So the entry just now I already given here. You credit the bank 320. So NCI you reduce it by 200. Okay, so 300,000 for 30%, 20% you win 200,000. So the difference 120 charged to OCE. Any questions? So you see, keep on repeating the debit credit on NCI must be debit because you buy more from NCI. NCI must redeem. You make payment must be in credit, the bank or payable. So different go to OCE. How different can it be? Okay. So the last one, we test you the theory. Okay. TM acquire 10% in YU, 3.2 million. In X7, so on 31st December, X9 acquire another 60%. So in this case, it changed a bit. So then we'll just erase this one. So usually when you just make a drawing, it's much easier for you to understand. So TM acquire YU. So you have 10%. So you bought another 60%. Now this thing is investment to subsidiary. Okay, investment to subsidiary. Then now what you need to do is the 10% one here, fair value it, get gain loss go to P&L. So when you reach 70%, you compute goodwill. So this is investment to subsidiary, the type 1. Okay, so this is relatively also quite easy. So you just compute goodwill when you first gain control. First time you reach more than 50%, 30%, 50%, sorry, 50. So now they ask you for the theory. You pay 10 million. You another share for 20 million. 10 million share for 20 million value. Fair value original 4 million. So this one can help you to compute goodwill if you want. Okay. NCI 11 million has no other investment. Each following statement are true. So maybe you can just do your calculation a bit. So you initially 10%, you buy 30%, so 30. So this correct. So your 10%, your 60% one you pay 10 million. The value original 10% now is 4 million given here. So they don't get NCI value at fair value of 11 million. So the 10 million share, they didn't give us the net asset or pre-acquisition profit, so we can't compute goodwill, okay? Because there's one amount missing. So anyway, they are testing you which 3 statements are true. So you need to select 3. The square here you must select 3. So goodwill recovery at both acquisition and the total. Both acquisition is wrong only when you reach 70 one time only, okay? First one wrong. NCI initially recognized at 31st December. Yes, it first gain control. Okay, when you buying your 31st December next time, when you get your 60%, so you gain your control. So goodwill will be included in consolidated financial only for 60%, which is wrong. It's for the 70%. Okay, the 10% you fair value it. Okay, original 10%. So could wait and say I recognize only when TM control you. Yes, when you reach the 70%. So any question? So the next one, you try yourself. Okay, pair a scenario. Okay, you can see your answer when you submit. Why only one student submitted? What the rest are other students? Don't know how to do. Okay.
Yeah, I don't know how to do.
Then you redo this the MCQ one. Then you watch the video again. Ask me questions. Still don't know. Okay. So this is not an easy topic. So you must read up first before you come. Unlike other subjects, because you guys after come back from your internship or after one exam, forgotten whatever you learned in the previous year in corporate reporting. Okay, so then you expect you can understand corporate reporting. Then you go to advanced corporate reporting. Then you miss out. You don't study, nobody can help you. Okay, so your basics it must be there. Then you keep on doing this online, it helps you a lot. Okay. Okay, then I give you one more some homework to do. You don't try, you will know one. Okay. This is objective question. One's objective, one scenario. Okay, you say, oh, this question I don't know, still can ask. So give you a homework. So try to do. I send you another set of online questions. You get a lot. No? I only give you half what I have only. Okay, because you all cannot cope. Okay, I end today's lecture. Anything? Any other question? Okay, thanks a lot. Bye.